Right now, your bank knows something about you. It knows you haven't checked your savings rate in months, maybe years, and it is charging you for that. Not with a fee, not in any way that shows up on your statement, by quietly paying you far less than it could, because it calculated, with precision, that you won't notice. A group of researchers from Harvard and the University of Chicago spent years studying how American banks actually make money. Their finding was uncomfortable. 58% of the average bank's profit has nothing to do with smart investing or financial expertise. It comes from one thing: the fact that once people put money in a bank, they stop paying attention. Banks have a name for this internally. They call it depositor sleepiness, and they don't just benefit from it. They price their entire business model around it. Think about the last time you actively checked what interest rate your savings account pays. Most people can't remember, not because they don't care about money. Most people care deeply about money, but because a savings account, once set up, disappears into the background of life. It's there. It's stable. The number slowly goes up. Nothing seems wrong. And that feeling of nothing seems wrong is exactly what banks rely on. The researchers found that 94% of depositors keep the same bank account every year. Not because they checked other options and decided to stay, because they never checked at all. The typical account, once opened, is used for about 8 years before any action is taken. And when people do close accounts, the researchers tracked why. The number one reason: they moved to a new city. The number two reason: a death in the family forced an account change. Finding a better interest rate somewhere else ranked so low in the data that it was almost a rounding error. Only 17% of account closures involved someone who switched specifically because another bank offered better terms. That's the data. Not an assumption, not a theory. That is how people actually behave with their savings. And banks don't just notice this pattern. They build their entire business model around it. Here's how the mechanism works. When you put money in a bank, you think of yourself as the customer. You're the one being served. You get the account, the app, the debit card, the branch. But in the economic model that banks use internally, you are not the customer. You are the product. More specifically, your future inattention is the product. Here's how that plays out. Every bank sits on a pile of deposits. Your money, your neighbor's money, millions of people's savings. The bank lends that money out at a high rate, let's say 7% on a mortgage. In return, it pays you a low rate on your savings, let's say 0.5%. That gap is how the bank makes money. Now, in a normal competitive market, this gap should shrink. If Bank A offers 0.5%, Bank B should offer 0.6% to steal your business. Then Bank C offers 0.7%. Competition drives rates up. Customers benefit. That's how markets are supposed to work. But that only happens if customers actually switch. And they don't. So Bank A can keep paying 0.5% for years without losing you. Not because they tricked you. Not because switching is impossible. Simply because you never got around to it. The researchers have a name for this dynamic: the invest versus harvest strategy. When a new depositor walks in, the bank invests. It offers a competitive rate to win the account. Once you're in and settled, the bank harvests. It quietly reduces what it pays you, knowing you probably won't leave. You were the investment. Now, you're the harvest. Let me show you what this looks like with real numbers. Maya is 33 years old. She lives in Charlotte, North Carolina. She's worked at the same marketing firm for 6 years. In 2019, she had $18,000 in a savings account at one of America's largest banks. 0.09% interest rate. She'd been with that bank since college. It felt stable, reliable, safe. In 2022 and 2023, the Federal Reserve raised interest rates aggressively. The Fed's benchmark rate went from near zero to over 5%. Mortgage rates climbed above 7%. Credit card rates jumped to record highs. Maya's savings account rate went from 0.09% to 0.15%. That's it, a fraction of a percent. Meanwhile, an online bank called Ally was offering 4.5% on the exact same type of savings account. FDIC insured. No fees. Instant transfers. Same protection as any other bank. The difference between 0.15% and 4.5% on $18,000 is roughly $783 per year. Over 3 years, that's more than $2,400. Maya didn't lose it through bad investments. She didn't spend it. She just didn't move. And here's the part that makes economists uncomfortable. Maya's bank knew she wouldn't move. They modeled it. They priced the account based on the statistical certainty that most customers, once settled, would stay indefinitely. Her inertia wasn't an accident the bank failed to notice. It was the asset they were counting on. Now here's where this gets bigger than one person's savings account. The Harvard study estimated the total value of this deposit franchise, the present value of all the future profits American banks expect to earn from depositors who won't leave. In 2022, that number reached $1.6 trillion. Not the total deposits in American banks, which is around $17 trillion. Just the expected future profit generated specifically because depositors don't switch. $1.6 trillion, built entirely on inertia. To put that in perspective, if every American depositor suddenly became an active shopper, if everyone compared rates and moved their money to the best available option each year, the researchers estimate that number would drop to around $600 billion. That's a $1 trillion gap. $1 trillion in expected profit that exists solely because the American public has never been taught to think of their savings account as a decision that requires regular attention. And that gap didn't appear overnight. Back in 2002, the deposit franchise value was around $400 billion. It grew steadily for 2 decades. By 2022, it had quadrupled, not because banks got smarter or more sophisticated, because the average depositor got sleepier. Each year, a new cohort of account holders opened accounts and then gradually stopped paying attention. Each year, the harvest grew. Here's the second layer, and it flips the whole story upside down. You might expect that banks in highly competitive markets, cities with many bank options, would pay depositors more. Basic economics. More competition means better rates. But the research found something strange. In concentrated markets, cities dominated by just a few big banks, the big banks do offer lower rates to their established customers. But smaller rival banks in those same cities aggressively compete for new depositors with higher rates. The result is that the actual rates people earn don't vary that much based on how competitive their local market is. What determines how much you earn is almost entirely whether you are actively shopping or not. Awake depositors, the ones who compare rates, earn more in almost any market. Asleep depositors, the ones who don't, earn less, almost everywhere. The researchers actually divided depositors into 2 categories: awake and asleep. The awake ones shop. They move money. They respond to better offers. The asleep ones stay put, year after year, account untouched. Banks set their interest rates with both groups in mind simultaneously. The rate you see advertised is designed to attract the awake ones. The rate you actually earn after a year or 2 is designed to harvest from the asleep ones. Most people start awake. Almost all of them eventually go to sleep. Why don't banks just compete honestly and offer everyone a fair rate? Because they don't have to. The researchers found that market concentration, how many banks exist in a given area, barely affects markups at all. This is a huge departure from how economists expect markets to behave. Normally, more competition equals lower prices for consumers. With banks and deposits, concentration barely matters. Because the real competition isn't between banks. It's between your present self and your future self. Your present self opened an account, chose a bank, and felt good about the decision. Your future self inherited that account and never revisited it. Banks exploit the gap between those two selves. Every year that your future self doesn't revisit the decision, the bank earns the harvest. And the longer you've been asleep, the harder it is to justify waking up. The amount you've lost in foregone interest feels abstract and past. The effort of switching feels concrete and present. That asymmetry between the invisible cost of staying and the visible friction of leaving is not an accident. It's the engine. And it operates across every income level. The Harvard study found that wealthier depositors and business account holders tend to be more active shoppers. They move money more often. They compare rates more frequently. The people who are sleepiest, who stay in the same accounts the longest without looking, are disproportionately lower income and older depositors. The people who can least afford to leave money on the table are the most likely to do so. And the banks that benefit most from depositor sleepiness are, predictably, the ones with the worst deposit rates and the lowest quality service. The researchers found something striking. Even moving from the bottom quarter to the top quarter of deposit service quality only reduces a bank's dependence on sleepiness by about 10 percentage points. Even good banks rely heavily on your inertia. Bad banks rely on almost nothing else. Sleepiness doesn't just benefit the banking system in general. It specifically rescues institutions that would lose customers immediately if those customers ever actually looked. Here is the part that no one talks about. The same research that exposed this system also found something genuinely surprising. The sleepy depositors are actually keeping American banks alive. Not metaphorically, literally. The study modeled what would happen if every American depositor suddenly became an active shopper during the Federal Reserve's aggressive rate hikes in 2022 and 2023. In that scenario, two of America's largest banks would have faced a probability of default exceeding 20%. Not Silicon Valley Bank, not a regional lender, two of the biggest money center banks in the country. Because here's the math. When the Fed raises rates rapidly, banks have to pay more to borrow from each other overnight. But if depositors are sleepy, banks don't have to raise deposit rates to keep them. That's cheap funding they can hang on to. If depositors suddenly woke up and demanded competitive rates or moved their money elsewhere, the cost of that funding would spike overnight, and some banks could not survive it. The FDIC insures your deposits. But the financial stability of major American banks depends on the statistical certainty that you won't move your money. Your passivity isn't just costing you, it's quietly subsidizing the institution that holds your savings. Here is the realization. Banks don't primarily profit from lending strategies or investment decisions or fee structures. They profit from a single, measurable, well-documented human behavior. The tendency to set something up once and then never look at it again. The researchers called it sleepiness. What it actually is trust. You trusted the bank when you opened the account. You trusted that the rate was fair. You trusted that if something was significantly wrong, someone would tell you. None of those trusts were violated in any legal sense. The bank paid you exactly what it promised. It just never told you that what it promised was calibrated specifically to the minimum you would accept without leaving. You weren't defrauded. You were modeled. There's an internal term that researchers use for this: the deposit franchise. The franchise is the present value of all the future profits a bank expects to earn from depositors who won't go anywhere. In 2022, the total deposit franchise value of American banks reached $1.6 trillion. That number isn't calculated from loans or investments or market movements. It's calculated from you. Specifically, from the statistical probability that you will remain exactly where you are. There is a difference between a bank that can't offer you a better rate and a bank that doesn't offer you a better rate because it is calculated with precision that you won't notice. 58% of its profit stream depends on that calculation being right. Every year. About you. The question isn't whether your money is safe. Your money is almost certainly safe. The question is who decided what your attention was worth and whether you were consulted.